European reinsurance companies just posted record profits of 11 billion euros, while American homeowners face the worst homeowners insurance crisis in modern history. You're paying 69% more for homeowners insurance than 3 years ago in 2024, and these companies are laughing all the way to the bank with profit margins that would make tech billionaires jealous. The insurance industry wants you to believe this is all about climate change and rising costs. That's only half the story. What they won't tell you is how a shadowy layer called reinsurance has turned your financial security into their profit machine. The numbers are staggering. Since 2019, homeowners insurance rates have exploded by more than 44% nationwide. In Florida, the average premium hit $5,376 annually, nearly 5 times the national average after Hurricane Ian devastated the state in 2022 and Hurricane Milton struck in 2024. Nebraska homeowners now pay almost $6,400 per year, the highest in the country. But here's what makes this truly infuriating. While you struggle to afford basic protection for your home, the reinsurance companies that sit at the top of this pyramid are posting profits so obscene they're breaking their own records year after year. Understanding reinsurance is the key to understanding why your premiums keep skyrocketing while industry executives get richer. Reinsurance is insurance for insurance companies. When your local insurer sells you a policy, they don't keep all the risk. They pass much of it up the chain to massive reinsurance companies with names like Munich Re, Swiss Re, Hannover Re, and SCOR. These are the real power players, the puppet masters pulling the strings behind the scenes, operating alongside Lloyd's of London in the global reinsurance markets. Here's where it gets interesting. While your insurance company faces heavy regulation from state agencies overseen by the NAIC, the National Association of Insurance Commissioners, that limit their profits to around 4.5%, reinsurance companies operate in a completely different world. They face virtually no regulation and can set their prices however they want. It's like having a casino where the house doesn't just have an edge, they get to change the rules mid-game, and change the rules they did. After hurricanes and wildfires from 2017 to 2022, reinsurance companies decided they'd had enough of absorbing losses. So they implemented what I call the attachment point strategy. Instead of covering losses from the first dollar, they raised their thresholds dramatically. Now, 85% to 90% of disaster losses get absorbed by your local insurance company, which means they get passed directly to you through higher premiums. But the reinsurers didn't stop there. They also jacked up their prices by 50% to 100% worldwide. Your local insurance company had no choice but to pay these extortionate rates, because without reinsurance, they can't operate. And of course, every penny of those increased costs got passed straight to you. The result? Munich Re just reported profits of 5.671 billion euros, beating their own targets for the 4th consecutive year. Swiss Re overtook them as the largest reinsurer with $43.1 billion in premiums. These 4 European giants achieved a combined ratio of just 81.5% in the first half of 2025, meaning for every dollar they collected in premiums, they only paid out 81 cents in claims. That's a 19% profit margin that most industries can only dream of. Meanwhile, over 6 million American homeowners have been priced out of coverage entirely. They're going bare, no insurance at all. That represents $1.6 trillion in unprotected property value. 1 in 8 homeowners now lacks coverage, with the crisis hitting minority communities hardest. 22% of Native American homeowners, 14% of Hispanic homeowners, and 11% of Black homeowners have no insurance protection whatsoever. But the real scandal isn't just the reinsurance markup. It's how insurance companies are gaming the system at the local level. A bombshell investigation in Florida uncovered what might be the most brazen insurance fraud scheme in American history. Between 2017 and 2019, Florida insurance companies claimed they lost $432 million. Poor them, right? They used these supposed losses to justify massive premium increases on struggling homeowners. But here's what they didn't tell the Florida Office of Insurance Regulation. While the insurance companies were crying poverty, their affiliated companies, sister corporations they owned and controlled, pocketed $1.8 billion in profits. How did they pull this off? Through a web of management fees, claims handling fees, and other charges that moved money from the regulated insurance company to unregulated affiliate companies. One insurer even used affiliate money to maintain a $485,000 annual hunting lodge for executives. Meanwhile, Demotech credit ratings continued to threaten smaller insurers with downgrades, forcing even more consolidation and market manipulation. The state of Florida commissioned a forensic accountant named John Moenk to investigate these transactions. She produced a comprehensive $150,000 report documenting the scheme. But here's the kicker. State regulators buried the report. They paid for it, received it, and then stuck it in a drawer. When legislators finally got their hands on it in 2025, they discovered the ugly truth about how homeowners had been systematically robbed. Doug Quinn from the American Policyholder Association called it the most eye-opening ray of sunlight to pierce the shadowy world of Florida homeowners insurance in years. The impact was huge. Florida policyholders had money taken directly from their pockets through fraudulent accounting tricks. This explains why insurance company executives are getting rich while you struggle to pay your premiums. CEOs at the top 10 auto and home insurance firms took home $391 million in compensation over 3 years, while hiking premiums by 24%. American Family Insurance raised rates by 17%, while more than doubling executive compensation to $8.4 million. The industry's response to criticism is predictable. When consumer advocates push for reform, insurance companies threaten to leave the market entirely. Doug Heller from the Consumer Federation of America says, "The insurance companies have become really aggressive in their bullying. You've heard a lot about companies that are threatening to pull out of the market if they don't get what they want. Generally speaking, that bullying has worked." And it has worked. Major insurers like State Farm, Allstate, and Progressive have fled high-risk states or dramatically scaled back coverage. At least 8 companies have stepped back from California's market. 11 Florida insurance companies are currently in liquidation. When insurers leave, homeowners get stuck with state-run programs that charge even higher rates. The timing of these exits is suspicious. Just as the hidden profit schemes were being exposed, and just as reinsurance companies were posting record earnings, these insurers suddenly decided certain markets were unprofitable. It's almost like they coordinated this strategy to maximize pressure on regulators and consumers. But there's hope on the horizon, and it comes from an unexpected source: the reinsurance market itself. After years of price gouging, capital is flowing back into reinsurance. Competition is increasing, and prices are finally dropping by 10% to 20%. Brian Kiefer, CEO of Allied Trust Insurance Company, says, "Reinsurers have been doing well the past few years after absorbing massive losses. Beginning in 2025, insurers are now finally starting to do better too. The ones still suffering are the policyholders. It is their turn now to get lower rates as the reinsurance costs soften." Some states are fighting back with real solutions. California passed SB 1656, requiring detailed disclosure of affiliate fees, reinsurance costs, and litigation expenses in rate filings. Florida lawmakers are conducting investigations with subpoena power, demanding transparency about executive pay and affiliated dealings. At the federal level, Senator Adam Schiff has introduced the Insure Act, which would create a federal catastrophe reinsurance program. The program would be capitalized with $50 billion in federal funds and provide reinsurance coverage for hurricanes, floods, wildfires, and other disasters. Schiff says, "This bill would create a federal risk reinsurance pool to bring down costs and make policies more affordable. All across America, in fire zones and floodplains and well beyond, the most valuable property a family may own is becoming uninsurable." The insurance industry opposes this plan, arguing it would shift risk to taxpayers. But here's the thing. Taxpayers are already bearing this risk through disaster relief, bailouts of state insurance programs, and the economic devastation that follows when communities become uninsurable. Amy Bach from United Policyholders supports federal action. "We are in the grip of an unprecedented national insurance crisis. The marketplace has changed dramatically for the worse, and the Insure Act can be the national solution we need. The evidence is overwhelming. Property and casualty insurers profited $169 billion last year, a 90% increase over 2023 and 333% increase over 2022. They're sitting on $2.8 trillion in assets, the highest surplus in history. This money could cover every home insurance policy in the nation and still leave a 30% cushion. Yet they continue to cry poverty while jacking up your rates. They continue to threaten market exits while posting record profits through affiliate schemes. And the reinsurance companies above them continue to extract billions from American homeowners while facing virtually no oversight. The system is rigged and you're paying the price. But knowledge is power. Now that you understand how reinsurance works, how affiliate schemes operate, and how the industry coordinates to maximize profits, you can demand better from your elected officials. Push for transparency requirements, support federal reinsurance programs, demand investigations into affiliate transactions, and most importantly, don't fall for the industry's sob stories about climate change and rising costs. Yes, disasters are expensive, but not expensive enough to justify the obscene profit margins these companies are extracting from your financial security. The middle class is being systematically bankrupted by an industry that has turned home protection into a wealth extraction machine. It's time to fight back.